Stock dividends are a way for companies to reward their shareholders by giving them extra shares instead of cash. It's a way for investors to increase their holdings in a company without spending more money, and for the company to share its success without reducing cash reserves. How do stock dividends work? When a company declares a stock dividend, it issues additional shares to its existing shareholders based on a percentage. For example, if a company announces a 10% stock dividend and you own 100 shares, you'll receive 10 extra shares, bringing your total to 110. The key point is that the total value of the company doesn't change. Instead, the value of each share is adjusted downward to reflect the increased number of shares. Your ownership percentage of the company remains the same. Why do companies issue stock dividends? Preserving cash. Companies may prefer stock dividends when they want to reward shareholders, but need to keep cash for reinvestment or debt repayment. Attracting investors. Issuing stock dividends can signal growth and stability, making the company more attractive to potential investors. Encouraging long-term holding. Stock dividends are often valued by investors who prefer to reinvest and grow their holdings over time, rather than receive immediate cash payouts. Example of a stock dividend. Let's say you own 200 shares of a company, and each share is worth $50, making your total investment $10,000. If the company announces a 10% stock dividend, you'll receive 20 additional shares, giving you a total of 220 shares. However, the share price will adjust. Instead of being worth $50, each share might now be worth $45.45 to reflect the increased number of shares. Your total investment remains the same at $10,000, but you now own more shares. Benefits of stock dividends. Increased ownership. Stock dividends grow your share count, which can compound over time if the company continues to perform well. Tax advantages. In some cases, stock dividends are not taxed immediately, unlike cash dividends, allowing for deferred tax benefits, depending on your location. Potential for growth. If the company grows and its stock price rises, the additional shares can become more valuable over time. Drawbacks of stock dividends. Dilution of value. Although you receive more shares, the value of each share decreases, so your total investment doesn't increase immediately. No immediate cash. Unlike cash dividends, stock dividends don't provide immediate income, which might not be ideal for investors seeking regular payouts. Market impact. Some investors may sell the extra shares, causing downward pressure on the stock price. Quick recap. Stock dividends reward shareholders by issuing additional shares instead of cash. Your ownership percentage stays the same, and the value of each share adjusts to account for the increase in shares. They're ideal for long-term investors looking to grow their holdings over time. No immediate cash payout, but they can offer tax benefits and compounding potential. Stock dividends are a smart tool for companies to share their success while encouraging long-term investment. For investors, they're a way to grow holdings and benefit from the company's future growth potential.